Ladies and gentlemen, it's been little over a month since the Fed kickstarted its most recent rate cut cycle with a big bang 50 basis point cut on 18th of September 2024. And since then, the Nifty has corrected by more than 2,000 points from its most recent peak. That's a correction of almost 8%. And while most investors have been caught unawares because of the sheer speed and scale of the correction that we have witnessed in equity markets over the last couple of weeks, it might be instructive to note that what we are witnessing in equity markets right now is almost a frame by frame repeat of what was witnessed in equity markets exactly 17 years back in the aftermath of the start of the rate cut cycle back in September of 2007. And that's why, ladies and gentlemen, if you're looking for clues for what potentially lies ahead for equity markets from here, your best bet probably lies in going and checking out what happened to equity markets 17 years back in the aftermath of the Fed starting its rate cut cycle from September 2007 onwards. Ladies and gentlemen, a very warm welcome to each and every one of you. I'm recording this video at the start of a week when all of us are looking forward to celebrating Diwali with our friends and family. And I want to take this opportunity to wish each and every one of you in advance a very happy Diwali and a very prosperous year ahead. You might be also noticing that I'm back to the familiar background of my office, and that's because I'm back home after almost a month-long visit to the United States. And believe me, ladies and gentlemen, there's no feeling better than being back home. Having said that, I had a very fruitful trip. I got the opportunity to spend time not just with friends and family, but I also got the opportunity during the trip to meet with a number of my clients who are based in the United States. And unfortunately, there were an equal number of clients and would-be clients whom I could not catch up with because of time limitations and the sheer volume of meeting requests that I received while I was in the United States. And that's why I wish to apologize to each and everyone who reached out with a meeting request while I was in the United States, but I could not oblige because of time limitations. But ladies and gentlemen, I promise I'm going to be back in the US very soon. And the next time I'm going to be in the US, I'm going to inform my audience sufficiently in advance on this channel so that we can schedule these meetings a little more efficiently. Now coming to what I want to discuss in this video, which is my current market outlook in the light of an absolute carnage that we have witnessed in equity markets over the last couple of weeks. First, we had the Federal Reserve in the US kickstart its most recent rate cut cycle with a big bang 50 basis point cut on 18th of September 2024. And that was cheered by very strong rallies by equity markets around the world. The Nifty here in India hit an all-time high of 26,216 points on 26th of September. But since then, the Nifty has corrected by more than 2,000 points. That's a correction of almost 8% from its most recent all-time high. And as expected, this has meant that my inbox has been inundated with messages from worried investors and clients who want to know if the correction that we have seen in the Nifty so far is only a prelude to a much larger market crash that potentially lies ahead. And if so, then how deep is any such market crash likely to be? But before I talk about my current market outlook, I want to set the context by doing a quick recap of the market outlook that I have reiterated in almost all my recent videos. Now, those of you who have followed me on my YouTube channel for a while would know that it's been my long-held view that equity markets would first witness a marked acceleration in the equity market rally as and when the Fed starts to cut Fed funds rate, and that this rally is likely to continue as the Fed continues with its rate cut cycle. But at the same time, I have also reiterated many times that I do believe that the US economy is likely to slip into a recession sooner rather than later. And as and when that happens, that's the point in time when the equity market rally is likely to fizzle out and eventually pave the way for a sizable market correction to play out. But before any such sizable market correction can play out, once again to repeat, I believe first equity markets are likely to witness a marked acceleration in the equity market rally. And it's in the light of this market outlook that many of you in my audience have been pointing out to me that that's not exactly how things have been playing out, at least over the last couple of weeks since the Fed started to cut Fed funds rate. Because since the time the Fed started to cut Fed funds rate on 18th of September 2024, far from seeing a marked acceleration in the equity market rally, we have in fact seen almost an 8% correction in the Nifty. So does that mean that my long-held views on how equity markets are likely to play out from here in the aftermath of the Fed starting its rate cut cycle something that has been shaped by what has been witnessed in equity markets in the aftermath of the Fed starting its rate cut cycle in the last two business cycles, now stands invalidated, and that equity markets are going to play out very, very differently in this particular business cycle? Or could it be that what is playing out in equity markets right now is in fact pretty much a repeat of what has already been witnessed in previous business cycles? Well, to understand this better, I need to take you back 14 years, back to September of 2007, because that's the most recent example we have of the Fed kickstarting its rate cut cycle with a big bang 50 basis point cut, the same quantum of cuts with which the Fed kickstarted its rate cut cycle in 2024. Now, this chart shows how the Fed funds rate has moved over the last 20 years. The blue line represents how the Nifty has moved during the same time. Now, this is a chart that I know I have shown in many of my previous videos, but this is something that is worth revisiting at this stage if you have to really understand if what is playing out in equity markets right now is pretty much a repeat of what has played out in previous business cycles, or this is something which is distinct from what has played out in previous business cycles. As you can see in this chart, the Fed started its rate cut cycle on 18th of September 2007 with a 50 basis point cut. And as soon as the Fed started to cut Fed funds rate, that kickstarted a furious rally in the Nifty, which went on for next 4 months, all the way till January of 2008. And in this intervening period of just 4 months, the Nifty rallied by a staggering 38%. A 38% rally in the Nifty in just 4 months. I want to take a pause at this stage and point out an error that I made while showcasing this chart in many of my previous videos. In many of my previous videos, I had indicated that the Nifty rallied by a staggering 45% between September 2007 and January 2008. But that's a mistake. This is something that I realized while going through the numbers all over again. As you can see in this chart, the correct quantum of rally between September 2007 and January 2008 was in fact 38%, not 45%. But notwithstanding the mistake that I made, the larger point that I was trying to make still stands, which is that once the Fed starts to cut Fed funds rate, Nifty typically witnesses a very strong acceleration in the ongoing equity market rally, and that's exactly what happened after September of 2007, which is when the Fed started to cut Fed funds rate. Within a short period of just 4 months, the Nifty rallied by a staggering 38%, and a 38% rally within a period of just 4 months would still qualify as a very strong acceleration in the equity market rally. But this rally started to fizzle out from January 2008 onwards, which is when the US economy slipped into a recession. And as soon as the US economy slipped into a recession, the Nifty also witnessed a brutal crash of 60% between January and October of 2008. In fact, this correction of 60% between January and October of 2008 continues to remain the worst crash in the history of the Nifty till date. Instead of focusing on the crash, I want to once again draw your attention to the 4-month period between September 2007 and January 2008, during which the Nifty rallied by a staggering 38%. Because when you take a closer look at what happened with the Nifty during this 4-month period, you will realize that what's happening with the Nifty right now is in fact eerily similar to what happened with the Nifty in the aftermath of the start of the rate cut cycle back in September of 2007. So let's take a closer look. This is the same chart, but I have zoomed in and I'm taking a closer look at the 4-month period between September 2007 and January 2008. And when you take a closer look at this 4-month period, you realize that while the Nifty indeed rallied by a staggering 38% during this 4-month period, this was hardly a rally in which the Nifty went up in a straight line. Far from it, this was in fact a very, very choppy ride. And that's because during this 4-month period, there were at least 3 instances where the Nifty corrected by more than 5%. The first one was a correction of almost 9%. The second one was a correction of almost 7%. And the third one was also a correction of almost 7%. So 3 corrections of 9%, 7%, 7%, all packed within a span of just 4 months. And despite these 3 sharp corrections, the Nifty managed to rally by 38% during the course of these 4 months. And mind you, we managed to get these 3 instances of pullback in the Nifty of the order of 9%, 7%, and 7% at a time when there was no other external geopolitical factor at play. There was no flare-up in conflict between Iran and Israel at that point in time as we do today. There was no sudden announcement of a stimulus in China, back then as we do today. And yet the Nifty managed to correct by more than 5%, as many as 3 times within a span of just 4 months. Ladies and gentlemen, now tell me, with this as the benchmark, can we really say what is happening with the Nifty right now is really very, very extraordinary? Despite a serious escalation of conflict in the Middle East, despite an announcement of a large stimulus in the second largest economy in the world, all we have got so far is a less than 8% correction in the Nifty from its most recent all-time high. In fact, the correction we have got in the Nifty so far, 7.8% to be precise, is less than the quantum of the first correction that was witnessed in the Nifty in the immediate aftermath of the start of rate cuts in September 2007. Back then, as we just saw, the first correction that was witnessed in the immediate aftermath of the Fed starting its rate cut cycle in September of 2007 was of the order of almost 9%. The limited point I'm trying to make here, ladies and gentlemen, is that the Nifty turning volatile and witnessing very sharp corrections in the immediate aftermath of the Fed starting its rate cut cycle is not really a very uncommon phenomenon. In fact, it's pretty much the norm, especially when the Fed kicks off the rate cut cycle with an initial cut of 50 basis points. And to that extent, the nearly 8% correction that we have witnessed in the Nifty so far in the immediate aftermath of the Fed starting its most recent rate cut cycle is very much in line with what has been witnessed with the Nifty in previous business cycles. In fact, I would dare say that given the kind of adverse geopolitical backdrop that we have right now in the light of an escalating conflict in the Middle East, I personally find it quite extraordinary that the correction that we have witnessed in the Nifty so far in the current business cycle since the start of rate cuts in the US has so far been only 7.8%. In any case, you've got to have the stomach to digest this kind of volatility at this stage of the business cycle. Because if I am right, and in this business cycle as well, the Nifty ends up delivering anywhere close to the 38% return that the Nifty delivered in 2007 between the points when the Fed started to cut Fed funds rate and the start of the recession in the US, then your only chance of being able to accrue those spectacular returns is if you are able to digest this kind of volatility at this stage. But is it that I'm trying to judge the correction that we have witnessed in the Nifty so far in this business cycle since the start of rate cuts as business as usual just because we have one instance of a similar correction in a previous business cycle? Because if that's the case, then it makes for a very weak argument. Or is it that there are other more fundamental factors at play, grounded in the laws of economics, which mandate that equity markets must become volatile after the start of rate cuts, especially when the rate cut cycle kicks off with a larger than average 50 basis point cut? Ladies and gentlemen, if it is coming from me, you can bet that I will never present an investment thesis if it is backed by historical precedents of something happening just once in history. In fact, those of you who have followed me for a while on my YouTube channel would know that I'll never present an investment thesis unless it is also backed by fundamental laws of economics and finance. What is this fundamental factor which is driving this kind of volatility in equity markets at this stage of the business cycle? Well, for that, you'll have to wait for part 2 of this video. But don't worry, you won't have to wait for another week or so for part 2 of this video. I'll try my level best to publish part 2 of this video in the next couple of days itself. But I assure you it's critical to have a thorough understanding of this fundamental factor, because only then will we also be able to understand by when this current bout of volatility is going to get over. But while I work on part 2 of this video, I would love to know your thoughts on what do you think this fundamental factor is likely to be. Please do post your thoughts in the comment section. I'm going to leave you behind with a hint. This factor has nothing to do with the ongoing conflict in the Middle East. This factor has nothing to do with the stimulus in China. Instead, this is a factor which is related to a slightly complex concept, which is volatility in the US government bond market. And this is something which is tracked through an index called the MOVE index. I know all this would be sounding like Latin at this stage, but don't worry, I'm going to break it up for you in very simple language, as I always do in part 2 of this video. And I assure you this is going to be worth the wait, because at the end of part 2, I'm pretty convinced that all of you would have a very good idea by when this current bout of volatility in the Nifty is going to be over. This brings me to the end of this video. I really hope that you liked the insights that I shared during the course of this video. If you did, then please do like and share this video. Last but not the least, please do consider subscribing to my channel. This is something that's not going to cost you anything, but it's going to be immensely helpful in increasing the reach of my content. Thank you very much.